We define value investing as very simply the purchase of something for significantly less than we think it's worth. I think it's also interesting to maybe state what isn't value investing. Value investing is not just simply buying cheap price to book companies. It's not just being mindlessly contrarian. It's not just buying stocks which have where the share prices have fallen a long way. So at the end of the day, it's trying to buy a decent business for significantly less than it's worth. We think investors should have exposure to value because there's an awful lot of evidence to suggest that value is one of the factors that generates an excess return in the long run. Why? Because we think that investors still have a horrible habit of overreacting to short-term news flow, which really doesn't have that much of an impact on a business. And what that does is it means that share prices are more volatile than probably they should be. Share prices tend to go down, on reacting to bad news, significantly below intrinsic value. But in the long run, they move back towards intrinsic value, and that's what generates the excess return. So we think now is a really good time to start increasing exposure to value, and it's because of the start point. The start point today is that the value of value, if you want to think about it that way, is very low. We've been through a period in which lots of money has gone into growth investing. It's driven up the valuations of that part of the market. And on the flip side, lots of money's come out of value stocks, and it means that value stocks today are trading at very, very low valuations relative to their long-run history.